Good morning, everyone, and a very warm welcome to Synapse Global Institute. My name is Alina, and I will be your lecturer for company law as you progress through this CPA program. I am delighted to have you in class today. Company law is a foundational subject for your professional training because it connects legal principles directly to accounting, auditing, taxation, and corporate governance. As we go through today's session, please feel free to use the chat section at any point to ask questions or seek clarification, especially where you feel a concept may be examined or applied in practice. We begin with the nature and characteristics of a company. A company is recognized by law as the most advanced and structured form of business organization. It does not come into existence informally, rather, it is created through a formal process of incorporation under statute. Once this incorporation process is complete, the company acquires a legal existence that is separate and distinct from the individuals who compose it. This separate legal existence is the cornerstone of company law and explains why companies occupy such a central role in modern commerce, finance, and professional practice. For you as CPA candidates, understanding this concept is not just about passing examinations. It is essential for your future work in preparing and auditing financial statements, advising on tax matters, and dealing with corporate governance issues. In statutory terms, a company is defined as a body corporate incorporated under the relevant Companies Act. Incorporation is the key event because it confers legal personality on the company, allowing it to function as an independent subject of rights and obligations. Once incorporated, the company is capable of owning property in its own name, entering into contracts, incurring debts and obligations, and suing or being sued independently of its members. This statutory meaning clearly distinguishes a company from unincorporated associations, such as sole proprietorships and partnerships, where the law does not recognize a separation between the business and the individuals behind it. The CPA syllabus places particular emphasis on this distinction because it directly affects liability, financial reporting, and audit responsibility. If at this stage you are already thinking about how this distinction affects balance sheets and liability disclosures, you are thinking in exactly the right direction. The most fundamental characteristic of a company is its status as a separate legal person. This principle was authoritatively established in the landmark case of Salomon v. Salomon and Co. Limited, 1897, AC 22. In that case, the House of Lords confirmed that once a company is legally incorporated, it becomes a person in law that is distinct from its shareholders, even if one individual holds the vast majority of the shares. The practical implications of this principle are far-reaching. The assets of the company belong to the company itself and not to its shareholders. The liabilities of the company are its own liabilities and not those of its members. Any legal proceedings involving the company must be brought by the company or against the company in its own name. For accountants and auditors, this explains why company accounts are prepared in the name of the company, why company assets must not appear in shareholders' personal balance sheets, and why corporate debts are not treated as personal liabilities of members. These are points that are frequently tested in CPA examinations through both direct questions and practical scenarios. Closely connected to separate legal personality is the principle of limited liability. Limited liability is one of the main reasons why the corporate form is so widely used in business. In a company limited by shares, members are liable only to the extent of any unpaid amount on the shares they hold. Where shares are fully paid, no further financial obligation arises, even if the company becomes insolvent. This principle was reinforced in Salomon v. Salomon and Co. Limited, where it was made clear that creditors must look to the company's assets for payment and cannot pursue shareholders personally. From a professional perspective, limited liability encourages investment by reducing personal risk affects audit risk assessment, especially in insolvency situations, and explains why creditors often require security or personal guarantees from directors in closely held companies. In examinations, you will often be required to distinguish clearly between limited liability in companies and unlimited liability in partnerships or sole proprietorships. So it is important that this principle is firmly understood. Another defining characteristic of a company is perpetual succession. A company continues to exist regardless of changes in its membership. The death, resignation, insolvency, or transfer of shares by any member does not bring the company to an end. This continuity of existence ensures stability in business operations and contractual relationships and allows for long-term planning, investment, and financing arrangements that would be impractical in business forms dependent on the continued existence of specific individuals. For accountants and auditors, perpetual succession explains why companies continue to prepare financial statements despite changes in ownership, and why long-term assets and liabilities are recognized on the assumption that the company will continue as a going concern, unless there's evidence to the contrary. If you have any questions on how this links to the going concern principle, please do raise them in the chat. Because a company is a separate legal person, it has the capacity to own property in its own name. Company property is legally distinct from the personal property of shareholders and directors. This principle was clearly illustrated in Macora v. Northern Assurance Co. Limited, 1925, AC 619, where the court held that a shareholder, even one who owned all the shares in the company, had no insurable interest in the company's property, because the property belonged to the company itself. The accounting relevance of this principle is significant. Company assets must be recorded in the company's books and not in those of shareholders. Transactions between the company and its members must be treated as dealings between separate legal persons. In owner-managed companies, misclassification of company and personal assets is a common audit risk, and you should be alert to this both in examinations and in practice. A company also has the capacity to sue and be sued in its own name. This reinforces its independent legal existence and responsibility. The decision in Foss v. Harbital, 1843, 2 Hair 461 established the rule that where a wrong is done to the company itself is the proper claimant. Individual shareholders generally cannot sue for wrongs done to the company, except in limited and well-defined circumstances. This rule has important implications for corporate governance and internal control, for auditors when assessing litigation risk, and for accountants when evaluating provisions and contingent liabilities in the financial statements. Do take a moment to reflect on how this principle affects who can bring legal action and how that, in turn, affects financial reporting. In companies limited by shares, ownership is represented by shares, which are generally transferable. This transferability allows members to exit the company without affecting its existence or operations. In private companies, transferability is usually restricted by the Articles of Association, whereas in public companies, shares are freely transferable and may be traded on a securities exchange. From a professional standpoint, share transfers affect equity accounting and disclosure. Restrictions on transfer may influence company valuation, and auditors must verify compliance with statutory and constitutional requirements relating to share movements. Unlike partnerships, where owners typically manage the business directly, a company operates through a centralized management structure. Control is vested in a board of directors who act as agents of the company and owe fiduciary duties to it. There is a clear separation between ownership and management. Shareholders exercise ultimate control through general meetings, but day-to-day management is delegated to directors. For CPA candidates, this characteristic is particularly relevant when studying directors' duties, evaluating governance structures, and assessing internal control systems and accountability mechanisms. Finally, it is important to appreciate the practical relevance of all these characteristics. They are not merely theoretical ideas. They underpin the preparation and audit of financial statements, the assessment of legal and financial risk, the interpretation of corporate transactions, and the application of ethical and governance standards. A strong grasp of the nature and characteristics of a company will enable you to approach company law questions with confidence and to apply legal concepts accurately in your professional work. If anything we have covered so far is unclear, please use the chat section to ask questions now or as we continue. Let us now move on to types of companies, which in your study guide is presented under the classification of companies. This area is extremely important for CPA examinations because many questions test not only your ability to identify different types of companies, but also your understanding of the legal, accounting, audit, and compliance implications that flow from each classification. As we go through this section, I encourage you once again to use the chat if you would like clarification, or if you want to test your understanding with an example. Companies are not uniform in form or function. The law recognizes different categories of companies, each designed to meet specific economic, legal, and governance needs. Classification is therefore essential because it determines which legal rules apply to a company, the extent of members' liability, disclosure obligations, and professional responsibilities for accountants and auditors. For CPA candidates, it is important not just to memorize the categories, but to understand why the law treats them differently and how those differences affect practice. One major basis of classification is according to the liability of members. The most common form is the company limited by shares. In this type of company, the liability of members is limited to the amount, if any, unpaid on the shares they hold. Once a shareholder has fully paid for their shares, no further liability arises, even if the company becomes insolvent. Creditors must look only to the company's assets for repayment. From a professional perspective, this explains why shareholders are not treated as debtors of the company on insolvency, and why this form of company is central to audit assessments of going concern and solvency. It also explains why companies limited by shares are widely used for commercial activities, as they encourage capital formation by limiting investor risk. Another form under this classification is the company limited by guarantee. Unlike companies limited by shares, these companies do not have share capital. Instead, members undertake to contribute a specified amount to the company's assets if the company is wound up. This obligation only becomes enforceable upon liquidation. Companies limited by guarantee are commonly used for non-profit purposes, such as professional bodies, educational institutions, and charitable organizations. Any surplus generated is reinvested to further the company's objectives, rather than distributed to members. For you as CPA candidates, the key points are the absence of share capital and dividends, the different reporting and disclosure considerations, and the treatment of members' guarantees as contingent obligations rather than equity. There are also unlimited companies. In an unlimited company, there is no statutory limit on the liability of members. If the company is wound up, members may be required to contribute without restriction to settle its debts. Although these companies are rare in practice, they may be used where members wish to demonstrate strong financial credibility or avoid certain disclosure requirements. From an accounting and audit perspective, unlimited liability significantly increases members' exposure to business risk and affects how contingent liabilities and risk disclosures are evaluated. Companies may also be classified according to the number of members. A private company is one that restricts the right to transfer its shares and prohibits invitations to the public to subscribe for its shares or debentures. Private companies usually have a smaller number of members and a more flexible internal structure. They are subject to fewer disclosure and compliance requirements than public companies, making them suitable for small and medium-sized enterprises. In CPA examinations, private companies are often used to test issues such as simplified financial reporting, restrictions on share transfers, and increased audit risk arising from the close overlap between ownership and management in owner-managed businesses. By contrast, a public company is permitted to offer its shares or debentures to the public and may list its securities on a recognized stock exchange. Because public funds are involved, public companies are subject to strict regulatory oversight, enhanced disclosure obligations, and higher standards of corporate governance. For CPA candidates, public companies are particularly important because they involve complex financial reporting requirements, extensive statutory disclosures, heightened audit and assurance expectations, and compliance with securities and capital markets regulation. Always remember that the distinction between private and public companies goes far beyond size. It fundamentally affects regulatory burden and professional responsibility. Another important basis of classification is ownership and control. A government company is one in which the majority of the share capital is held by the state, either directly or through other government-controlled entities. Although such companies operate as separate legal persons, public interest considerations often influence their objectives and governance. Professionally, these companies raise issues relating to accountability for public resources, compliance with both company law and public finance principles, and specialized audit and reporting standards. Closely related to this is the concept of holding and subsidiary companies. A holding company is one that controls one or more other companies, known as subsidiaries. Control usually arises through ownership of a majority of voting rights, or the power to appoint or remove directors. Although each company within a group retains its own separate legal personality, group structures create complex accounting and legal issues. Courts have consistently affirmed that a subsidiary remains a separate legal entity even when it is wholly owned. For CPA candidates, this classification is critical when preparing consolidated financial statements, assessing related party transactions, and understanding group liability and governance structures. Companies may also be classified according to their purpose. Most companies are profit-making companies, formed with the objective of generating profit for distribution to shareholders. These companies engage in commercial activities and distribute profits as dividends, subject to statutory and accounting rules. The professional relevance here includes profit measurement, rules on distribution, taxation of corporate profits and dividends, and capital maintenance. Principles. In contrast, some companies are formed for non-profit or special purposes. These companies pursue social, professional, or charitable objectives rather than profit. While they may generate surplus income, that surplus is applied towards achieving the company's stated objects rather than being distributed to members. For accountants and auditors, these entities require careful distinction between surplus and distributable profits, as well as compliance with specific reporting and governance obligations. In CPA examinations, classification of companies is frequently tested through questions that require you to distinguish between types of companies, link classification to liability and disclosure requirements, and apply these principles to practical scenarios. A clear and structured understanding of the different types of companies will enable you to analyze problem questions accurately and to apply company law principles effectively in professional practice. If you would like to test yourself with an example, or if any category is still unclear, please raise it in the chat. Let us now turn to one of the most fundamental and examinable areas of company law, namely the principle of legal personality and the veil of incorporation. This topic sits at the very heart of company law and underpins many of the issues you will encounter in CPA examinations, particularly questions on liability, group structures, fraud, and corporate accountability. Please stay alert to the case law as we go through this section, and do use the chat if you would like clarification at any point. The doctrine of legal personality explains why a company, once incorporated, is treated by law as a person in its own right, separate and distinct from its members, directors, and employees. Upon incorporation, the company acquires an independent existence in law and becomes capable of enjoying rights and bearing obligations in its own name. This means that the company can own property, enter into contracts, incur debts, and be responsible for its own legal obligations without those rights and obligations automatically attaching to the individuals behind it. This concept is not merely theoretical. It is the legal foundation upon which modern corporate activity is built. The principle of legal personality was conclusively established in the landmark case of Salomon v. Salomon and Co. Limited, 1897, AC 22. In this case, Mr. Salomon incorporated a company in which he effectively controlled the business and held the majority of the shares. When the company later became insolvent, creditors argued that the company was merely a facade and that Mr. Salomon should be personally liable for its debts. The House of Lords rejected this argument and held that once the statutory requirements for incorporation are satisfied, the company becomes a distinct legal person, regardless of the level of control exercised by one individual. The company's debts were therefore its own, and Mr. Salomon was not personally liable beyond the limits imposed by law. For CPA candidates, this case is critical because it explains why company liabilities do not appear as personal liabilities of shareholders and why company accounts must be prepared separately from those of members. The consequences of legal personality are significant. The company owns its property independently of its members, meaning shareholders have no direct ownership rights over company assets. The company enters into contracts in its own name, and liability under those contracts rests with the company, not with the individuals who manage or own it. The company bears responsibility for its own debts and obligations, and it continues in existence irrespective of changes in membership. From an accounting and auditing perspective, this principle explains why transactions must be recorded as those of the company itself, even where shareholders or directors exercise complete control over operations. Closely connected to legal personality is the concept of the veil of incorporation. The veil of incorporation is a metaphor used to describe the legal boundary that separates the company from its members and directors. This veil shields shareholders from personal liability for the company's debts and protects directors from personal responsibility for corporate obligations, provided they act lawfully and within their authority. The veil promotes commercial certainty and encourages investment by allowing individuals to conduct business through a corporate structure without exposing their personal assets to business failure. In practical terms, the veil of incorporation means that creditors must claim against the company and not against its members. Shareholders are not entitled to company property, and directors act as agents of the company rather than as principals. This separation is fundamental to corporate finance and accounting practice, and is a recurring theme in CPA examination questions that test your understanding of liability and responsibility. However, the veil of incorporation is not absolute. In exceptional circumstances, courts may lift or pierce the corporate veil and hold individuals personally liable. This is not done lightly. Courts are generally reluctant to disregard the company's separate legal personality, and will not do so merely because it appears fair or convenient. The leading modern authority is Prest v. Petrodel Resources Limited, 2013, UKSC 34, where the Supreme Court clarified that piercing the veil is a narrow and limited doctrine. It applies only where a company is used as a device to evade existing legal obligations, or to frustrate the enforcement of rights. One situation in which the veil may be lifted is where there is fraud or improper conduct. Where a company is formed or used to conceal wrongdoing or perpetrate fraud, courts may disregard its separate personality. This was clearly demonstrated in Guildford Motor Co. Limited v. Horn, 1933, ch. 935, where a company was incorporated specifically to avoid a non-competition covenant. The court held that the company was a mere facade and restrained its use. For CPA candidates, this principle is particularly relevant when assessing transactions designed to disguise liabilities, misstate financial positions, or evade creditors. Another situation arises where a company is used to evade existing legal obligations. In Prest v. Petrodel Resources Limited, the court emphasized that veil piercing is aimed at preventing abuse of the corporate form rather than providing a general remedy whenever justice seems to require it. From a professional standpoint, this reinforces the importance of substance over form when evaluating corporate structures and transactions, especially in audit and advisory engagements. Issues may also arise in the context of agency and group enterprises. In certain circumstances, a company may be treated as an agent of its controlling shareholder or parent company. In Smith, Stone and Knight Limited v. Birmingham Corporation, 1939, for all ER 116, a subsidiary was treated as an agent of its parent due to the level of control exercised. However, courts generally uphold the separate legal personality of group companies. In Adams v. Cape Industries plc, 1990, ch. 433, it was held that a parent company is not liable for the debts of its subsidiary merely because it exercises control over it. This distinction is crucial for CPA candidates dealing with group reporting, consolidation, and assessment of group liability. From both an examination and professional perspective, the principle of legal personality and the veil of incorporation is frequently tested through problem questions involving shareholder and director liability, group structures, fraud, misrepresentation, and improper conduct. In practice, these principles guide the preparation of separate and consolidated financial statements, the assessment of contingent liabilities and legal provisions, and the evaluation of governance and ethical compliance. A clear understanding of when the veil protects individuals and when it may be lifted is essential for accurate legal analysis and sound professional judgment. If you have any questions about the cases we have discussed or how these principles apply in examinations, please raise them in the chat. We now move to the distinction between companies and other forms of business associations, specifically sole proprietorships, partnerships, and cooperative societies. This is a highly examinable area in company law because it requires you to compare legal personality, liability, ownership, management, and continuity, and then link those distinctions to accounting, audit, and professional practice. As we go through this discussion, keep in mind that examination questions often ask you to advise on the most appropriate form of business in a given scenario, so clarity and comparison are essential. Please feel free to use the chat at any point if something needs further explanation. Although companies are the most prominent form of business organization in modern commerce, they exist alongside other business associations such as sole proprietorships, partnerships, and cooperative societies. Each of these forms has its own legal characteristics, advantages, and limitations. A clear understanding of their differences is vital for CPA candidates because those differences directly affect liability exposure, risk assessment, governance, and financial reporting. A sole proprietorship is the simplest form of business association. It is owned and managed by a single individual, and unlike a company, it does not have a separate legal personality. In law, the business and the proprietor are the same person. All rights and obligations of the business attach directly to the owner. This means that contracts are entered into by the proprietor personally, and any debts incurred by the business are personal debts of the owner. By contrast, a company exists independently of its members, with rights and liabilities distinct from those of its shareholders. This distinction explains why a sole proprietor is personally liable for all business debts, while shareholders in a company generally enjoy limited liability. Liability is therefore one of the clearest points of distinction. In a sole proprietorship, liability is unlimited. If the business fails, creditors may claim against the personal assets of the proprietor, including property not used in the business. In a company limited by shares, however, members are liable only to the extent of any unpaid amount on their shares. For CPA candidates, this difference is crucial when evaluating business risk, insolvency exposure, and the suitability of a particular business structure for capital-intensive or high-risk activities. Continuity and transferability further distinguish the two forms. A sole proprietorship lacks perpetual succession. The business typically comes to an end upon the death, incapacity, or withdrawal of the proprietor. There is no automatic continuation of the business as a separate entity. A company, on the other hand, enjoys perpetual succession. It continues to exist regardless of changes in ownership or management. From an accounting perspective, this affects going concern assessments and long-term financial planning and reporting. Turning now to partnerships. A partnership is an association of two or more persons carrying on business with a view to profit. Like a sole proprietorship, a partnership generally does not possess a separate legal personality distinct from its members. Partnership property is owned collectively by the partners, and the partners are jointly responsible for the obligations of the firm. In contrast, a company owns its property independently and bears liability for its own debts. This distinction is particularly important in audit engagements involving professional firms structured as partnerships. Liability in a partnership is typically joint and several. Each partner may be held liable for the full amount of the partnership's debts, regardless of any internal profit-sharing arrangements between partners. Creditors are therefore entitled to pursue any one partner for the entire debt. In contrast, company shareholders benefit from limited liability, and directors are not personally liable for company debts unless exceptional circumstances arise, such as fraud or breach of duty. This distinction is frequently tested in CPA examinations and is central to advising clients on business structure. Management and control also differ significantly. In a partnership, partners usually participate directly in the management of the business unless they agree otherwise. Decision-making is often personal and based on mutual trust. In a company, management is centralized in the board of directors, while shareholders exercise indirect control through voting at general meetings. This separation of ownership and control introduces formal governance and accountability mechanisms that are largely absent in partnerships and is a key feature examined in company law. Cooperative societies represent another distinct form of business association. A cooperative society is a member-based organization formed primarily to promote the economic or social interests of its members rather than to maximize profits for external investors. While companies are usually formed for profit and distribute surplus as dividends to shareholders, cooperative societies prioritize member welfare. Any surplus generated is typically reinvested in the society or distributed to members based on their participation rather than their capital contribution. Ownership and control in cooperative societies are based on democratic principles, commonly expressed as one member, one vote. This contrasts sharply with companies, where voting power is generally proportional to shareholding. For CPA candidates, this difference is relevant when assessing governance structures, internal controls, and accountability mechanisms. In terms of legal personality and liability, most cooperative societies are recognized as separate legal entities, similar to companies. However, their statutory framework and operational philosophy differ. Although member liability may be limited, cooperative societies place greater emphasis on collective responsibility and participation rather than capital investment. This affects financial reporting, performance measurement, and the interpretation of surpluses. In summary, a company is distinguished from sole proprietorships and partnerships by its separate legal personality, limited liability of members, perpetual succession, and centralized management structure. Sole proprietorships and partnerships generally lack separate legal personality, expose owners to unlimited liability, and depend heavily on the continued involvement of specific individuals. Cooperative societies, while often having separate legal personality, differ from companies in purpose, ownership structure, and governance philosophy. In CPA examinations, you are often required to advise on the most suitable business structure in a given scenario, explain liability implications for owners and managers, and distinguish the accounting and audit consequences arising from different legal forms. A sound understanding of these distinctions will enable you to link company law principles with practical financial and professional considerations confidently and accurately. If you have any questions, or would like to test your understanding with an exam-style scenario, please post it in the chat. When you are ready, take a brief pause, and then we shall continue with the next part of our lecture. We now begin Chapter 2 on the formation of companies, starting with Section 2.1, which deals with promoters and pre-incorporation contracts and deeds. This section is particularly important for CPA candidates because it examines the legal position before a company comes into existence and highlights issues of liability, risk, and enforceability that often arise in both examinations and professional practice. Please follow closely and feel free to raise questions in the chat as we go along. The formation of a company is not a single event, but a legal process that begins before incorporation and ends when the company acquires a separate legal personality. The early stage of this process is dominated by the activities of promoters. Understanding who promoters are, what they do, and the legal consequences of their actions is essential because a company, before incorporation, has no legal existence and therefore cannot act for itself. A promoter is a person who undertakes to form a company and takes the necessary steps to bring it into existence as a business entity. Although company legislation does not always provide a precise statutory definition of a promoter, the concept is firmly established in common law. In the case of Twycross v. Grant, 1877, 2 CPD 469, a promoter was described as a person who undertakes to form a company with reference to a given project and sets it going by taking the necessary steps to accomplish that purpose. In practical terms, the promoter is the driving force behind the incorporation of the company. Promoters typically carry out a wide range of functions during the formation stage. These include conceiving the business idea and assessing its feasibility, identifying and bringing together the initial shareholders, arranging preliminary finance, and determining the initial capital structure, preparing the documents required for incorporation, and entering into preliminary contracts that are necessary for the future operations of the company. From a professional point of view, these activities are significant because they shape the company's initial financial and legal position, which later affects accounting records, audit evidence, and governance structures. In law, the status of a promoter is quite distinctive. A promoter is not an agent of the company, because agency requires a principal capable of authorizing the agent, and a company does not exist prior to incorporation. Similarly, a promoter is not a trustee of the company, because there is no company in existence to benefit from a trust. However, despite not being an agent or trustee, promoters occupy a fiduciary position in relation to the company they promote. This fiduciary duty requires promoters to act in good faith and in the best interests of the future company. The fiduciary nature of the promoter's position was clearly established in Erlinger v. New Sombrero Phosphate Co., 1878, 3 Upcas, 1218. In that case, the House of Lords held that promoters must make full disclosure of any profit or benefit they obtain in the course of promoting the company. If a promoter fails to disclose such profits, the company may be entitled to rescind the contract or recover the secret profit. For CPA candidates, this fiduciary obligation is especially relevant when considering the disclosure of related party transactions, the accounting treatment of promoters, remuneration or benefits, and ethical responsibilities during corporate formation. A major legal issue arising at the promotion stage concerns pre-incorporation contracts. A pre-incorporation contract is a contract entered into by a promoter on behalf of a proposed company before it is legally incorporated. At this stage, the company does not yet exist and therefore lacks legal capacity. As a result, it cannot be a party to a contract. The general rule at common law is that a company cannot be bound by a contract made before its incorporation, even if it later adopts or benefits from that contract. This principle was firmly established in Kellner v. Baxter, 1866, LR 2 CP 174. In that case, promoters entered into a contract on behalf of a proposed company, which was later incorporated and benefited from the contract. The court held that the company could not ratify the contract because ratification requires the principle to have been in existence at the time the contract was made. Since the company did not exist at that time, ratification was legally impossible. Because the company does not exist at the time of contracting, the promoter who enters into a pre-incorporation contract is personally liable, unless the contract expressly provides otherwise. This personal liability arises because the promoter signs the contract in their own name, and there is no legal principle capable of assuming liability at that point. In Kellner v. Baxter, the promoters were held personally liable under the contract, even though the company later came into existence and benefited from it. From an accounting and audit perspective, this means that liabilities under pre-incorporation contracts remain personal to promoters until they are properly transferred, and such liabilities should not appear in the company's books unless they have been legally assumed by the company. Although a company cannot ratify a pre-incorporation contract in the strict legal sense, it may, after incorporation, enter into a new contract on similar terms. This process is known as novation. Novation involves the creation of a new contract between the company and the third party, and, if expressly agreed, the discharge of the promoter from personal liability. For CPA candidates, it is essential to distinguish clearly between ratification, which is legally ineffective, and novation, which creates enforceable obligations for the company. In addition to contracts, promoters may also execute pre-incorporation deeds. A deed is a formal legal instrument executed with specific statutory formalities. Like contracts, deeds executed before incorporation cannot bind the company, because the company does not yet exist. Pre-incorporation deeds are commonly used in transactions involving land and buildings, long-term leases, and transfers of significant assets. As with pre-incorporation contracts, the promoter who executes a deed before incorporation is personally liable unless, and until a valid novation, or a fresh deed is executed after incorporation. This is particularly relevant in professional practice, where property is acquired for an intended company and the accounting treatment depends on who legally owns the asset. Promoters may limit or avoid personal liability by taking specific steps. These include expressly providing in the contract that liability will cease upon incorporation and novation, and ensuring that a fresh contract is promptly executed by the company after incorporation. However, unless such steps are taken, promoters remain personally liable, regardless of whether the company later benefits from the transaction. From an examination and practical perspective, promoters and pre-incorporation contracts are frequently tested through problem questions on liability, scenarios involving defective incorporation, or unenforceable contracts, and ethical issues relating to disclosure and fiduciary duties. In practice, accountants and auditors must be able to identify obligations arising before incorporation, ensure correct classification of liabilities, and verify that contracts attributed to the company are legally binding. A sound understanding of promoters and pre-incorporation contracts and deeds will enable you to analyze formation stage risks accurately and apply company law principles with confidence in both examinations and professional work. If you have any questions on promoters' liability or on how novation works in practice, please raise them in the chat. We now continue with Chapter 2 on the formation of companies by examining the process and drafting of documents required to form a company. This section is particularly relevant for CPA candidates because it connects legal procedure with practical professional work, especially in company secretarial practice, audit planning, regulatory compliance, and verification of a company's legal existence. As we go through this process, please remember that examination questions often test not just your knowledge of the steps involved, but also the legal significance of each document and the consequences of non-compliance. Do feel free to ask questions through the chat if anything needs clarification. The incorporation of a company is a formal legal process governed strictly by statute. A company does not come into existence simply because individuals agree to carry on business together. It only acquires legal personality when all statutory requirements have been satisfied and registration has been completed. Until that point, the company has no legal existence and cannot exercise rights or assume obligations. For this reason, the incorporation process is designed to ensure legality, transparency, and accountability. The process of incorporation begins with a decision on the nature and structure of the proposed company. This involves determining whether the company will be private or public, whether it will be limited by shares or by guarantee, and the size and composition of its share capital where applicable. These initial decisions are fundamental because they determine the company's liability structure, reporting obligations, governance requirements, and regulatory burden. From a professional perspective, these choices also affect future accounting treatment, audit scope, and compliance responsibilities. Once the basic structure has been decided, the promoters must select an appropriate company name. The proposed name must comply with statutory rules, be distinctive, and must not be misleading or prohibited by law. Approval of the company name by the Registrar of Companies is a prerequisite to incorporation. If the name does not meet legal requirements, registration will be refused, and the incorporation process cannot proceed. This explains why name approval is always one of the earliest steps in forming a company. After the preliminary decisions have been made and the name approved, the promoters prepare the constitutional and statutory documents required for registration. These documents define the company's identity, internal governance framework, and ownership structure. Once prepared and properly executed, they are lodged with the Registrar of Companies together with the prescribed registration fees. If the registrar is satisfied that all legal requirements have been met, a certificate of incorporation is issued. This certificate marks the birth of the company as a legal person. The Memorandum of Association is one of the key documents required for incorporation. It evidences the intention of the subscribers to form a company and to become members of it. In effect, it represents the company's charter and forms part of its constitution. The memorandum typically states the name of the company, the location of its registered office, the objects or purpose for which the company is formed, the liability of its members, and the amount of share capital and its division into shares where the company is formed with share capital. By signing the memorandum, the subscribers agree to take a specified number of shares and to be bound by the company's constitution. For accountants, the memorandum is important because it provides insight into the company's permitted activities and capital structure, both of which may influence accounting treatment and disclosures. Alongside the memorandum, the Articles of Association must be prepared. The articles are the internal rules that govern the management and administration of the company. While the memorandum defines the company's relationship with the outside world, the articles regulate internal affairs. They commonly deal with matters such as the rights and obligations of shareholders, the appointment, powers, and duties of directors, procedures for meetings and resolutions, rules governing share transfers and dividends, and the methods by which company documents are executed. In many jurisdictions, companies may adopt statutory model articles, modify them, or draft bespoke articles. From a CPA perspective, the articles are particularly important when assessing directors' authority, evaluating governance procedures, and determining whether internal controls and decision-making processes have been properly followed. Where a company is formed with share capital, a statement of capital and shareholdings is also required. This document sets out the company's issued share capital and provides details of the total number of shares issued, the nominal value of each share, the rights attached to different classes of shares, and the identity of shareholders together with their respective holdings. This statement is fundamental to equity classification in the financial statements and is an important source document for auditors when verifying share capital and ownership. The incorporation process also requires the submission of particulars of directors and, where applicable, the company secretary. These particulars identify the individuals responsible for managing the company and ensure accountability. This information enables regulators, creditors, and other stakeholders to know who is charged with governance. For auditors and accountants, these disclosures assist in assessing management responsibility, identifying related party risks, and understanding the governance structure of the company. In addition, a declaration of compliance is usually required. This declaration confirms that all statutory requirements relating to incorporation have been complied with. It is typically made by a promoter, a director, or a professional advisor involved in the formation process. The declaration reinforces the principle that incorporation is a privilege granted by law, and that strict compliance with statutory provisions is required. Once all the required documents have been properly prepared, executed, and filed, and the registrar is satisfied that the legal requirements have been met, a certificate of incorporation is issued. This certificate is conclusive evidence that the company has been duly incorporated. From the date stated on the certificate, the company acquires separate legal personality, perpetual succession, and the capacity to carry on business in its own name. This moment is critical because it marks the transition from a proposed entity to a fully recognized legal person. From an examination perspective, CPA candidates are frequently tested on the incorporation process through direct questions on statutory requirements and through problem scenarios involving defective incorporation or improperly drafted documents. In professional practice, accountants and auditors must verify that a company has been properly incorporated, confirm the accuracy and consistency of its constitutional documents, and ensure that financial records reflect the company's legal structure and capital accurately. A thorough understanding of the process and drafting of documents required to form a company provides a strong foundation for applying company law principles confidently in both examinations and professional engagements. If you have any questions about the role of particular documents or their practical implications, please post them in the chat. We now move to the rules relating to company names, an area that may appear straightforward at first glance, but carries significant legal and professional consequences. For CPA candidates, this topic is important because a company's name is not merely a branding tool. It is a legal identifier regulated by statute, and failure to comply with naming rules can lead to penalties, compliance failures, and audit issues. As we go through this section, keep in mind how company names appear in statutory filings, financial statements, audit reports, and contracts. Please use the chat at any point if you would like clarification. The choice and registration of a company name is a critical step in the incorporation process. A company's name gives it a legal identity distinct from other entities and enables regulators, creditors, and the public to know exactly who they are dealing with. It also facilitates commercial recognition in the marketplace. From a professional perspective, the company name must appear correctly and consistently on statutory returns, accounting records, audit reports, tax documents, and contractual instruments. Any defect or irregularity in the company name can therefore have legal, regulatory, and practical consequences. Company legislation imposes mandatory rules that must be satisfied before a name can be registered. One of the most important requirements is distinctiveness. A proposed company name must not be identical to, or so similar to, the name of an existing registered company that it is likely to cause confusion. The purpose of this rule is to protect the public and existing businesses from being misled. Names that differ only slightly in spelling, punctuation, or the use of common or descriptive words may still be rejected if they are considered deceptively similar. The Registrar of Companies has discretionary power to refuse registration where similarity is likely to mislead. This explains why name approval is a preliminary step in incorporation and why, in some cases, companies may later be required to change their names following regulatory intervention. Statute also requires the use of specific words or suffixes in company names to indicate legal status. Companies with limited liability are generally required to include words such as limited or the abbreviation limited in their names. This requirement serves an important protective function by informing creditors and the public that the liability of members is limited. If a company fails to use the appropriate suffix, its officers may be exposed to statutory penalties, and in certain circumstances, the enforceability of contracts may be affected. For CPA candidates, this requirement reinforces the link between company law and creditor protection. Certain words and expressions are restricted because they imply a particular status, activity, or level of regulation. Words suggesting banking, insurance, education, or a connection with government or public authorities usually require prior approval from the relevant regulatory body. The rationale behind this restriction is to prevent companies from misleading the public into believing that they are authorized or regulated to carry on activities for which they lack legal approval. From an accounting and audit perspective, the use of restricted words without approval may indicate regulatory non-compliance and increased legal risk, which may need to be considered when assessing compliance and disclosure. In addition to restricted words, company legislation prohibits names that are misleading, offensive, or contrary to public policy. A company name must not suggest an unlawful purpose, misrepresent the nature of the company's activities, or imply an association with government or public bodies where no such association exists. If a company is registered with an inappropriate name, the registrar may later direct the company to change it. Failure to comply with such a direction can result in statutory penalties. For professional accountants, this highlights the importance of ongoing compliance, not just at the point of incorporation. A company is permitted to change its name after incorporation, usually by passing a special resolution and notifying the registrar. The change of name only takes effect once it has been registered and a new certificate reflecting the new name has been issued. Importantly, a change of name does not affect the company's legal identity. The company remains the same legal person and its rights, obligations, contracts, and liabilities continue unaffected. For CPA candidates, this principle is particularly relevant when dealing with continuity of accounting records, comparability of financial statements across periods, and maintaining clear audit trails following rebranding or restructuring. Statute also requires companies to disclose and properly use their registered names. The registered name must be displayed at the company's registered office and included on official documents such as invoices, business letters, contracts, and financial statements. This requirement promotes transparency, and ensures that those dealing with the company can easily identify the legal entity responsible for transactions. Failure to properly disclose the company name may lead to fines and, in some cases, may expose directors or officers to personal liability. In CPA examinations, questions on company names commonly test compliance with statutory naming rules, the consequences of using prohibited or misleading names, and the legal effects of changing a company's name. In professional practice, accountants and auditors must ensure that the company's registered name is correctly and consistently stated in financial statements and reports, that statutory records align with accounting documents, and that any naming irregularities are identified as potential compliance risks. A clear understanding of the rules relating to company names will enable you to address both legal and practical issues with confidence and precision. If you have any questions on naming rules or would like to explore an exam-style scenario, please post it in the chat. We now turn to the Memorandum and Articles of Association, which together form the constitutional foundation of a company. This section is very important for CPA candidates because these documents define the company's legal identity, its permitted scope of activities, and the framework within which it is governed and managed. They have direct implications for accounting treatment, audit procedures, corporate governance, and compliance. As we go through this discussion, please keep in mind how frequently examination questions require you to distinguish between these two documents and to apply their provisions to practical scenarios. Do use the chat at any point if you need clarification. The Memorandum of Association is the primary constitutional document of a company. It evidences the intention of the subscribers to form a company and to become members of it, and it sets out the fundamental conditions upon which the company is incorporated. In this sense, the memorandum represents the company's charter. By signing the memorandum, the subscribers agree to take a specified number of shares, where the company has share capital, and to be bound by the company's constitution. The memorandum therefore establishes the company's legal foundation and signals to the outside world the basic parameters within which the company is authorized to operate. The memorandum typically contains several key elements. It states the name of the company, which identifies it as a legal person. It specifies the location of the registered office, which determines the company's legal domicile and jurisdiction for regulatory purposes. It sets out the nature of members' liability, indicating whether the company is limited by shares, limited by guarantee, or unlimited. It also states the objects or purposes for which the company is formed, and where applicable, it specifies the amount of share capital and its division into shares. For professional accountants, the memorandum is important because it provides insight into the company's permitted activities and capital structure, both of which may influence accounting policies, disclosures, and risk assessment. Historically, the objects clause in the memorandum was of great legal significance because of the doctrine of ultra vires. Under this doctrine, any act or contract entered into outside the company's stated objects was void and unenforceable. This principle was illustrated in Ashbury Railway Carriage and Iron Co. Limited v. Risch, 1875, LR 7 HL 653, where a contract was held to be void because it fell outside the company's stated objects. Although modern company legislation has significantly reduced the strict application of the ultra vires doctrine, particularly to protect third parties dealing with companies in good faith, the memorandum remains relevant in defining the company's purpose and regulatory scope. For CPA candidates, this highlights the need to appreciate both the historical development and the modern practical position of company law. Alteration of the memorandum is not a casual matter. Because the memorandum contains fundamental information about the company, changes to it are subject to statutory control. Alterations to key elements such as the company name, the liability clause, or the share capital usually require a special resolution of shareholders and registration with the registrar. From a professional perspective, this means that accountants and auditors must be alert to whether fundamental changes to a company's structure or purpose have been properly authorized and correctly reflected in statutory records and financial disclosures. Alongside the memorandum are the Articles of Association. The Articles of Association are the internal rules that govern the day-to-day management and administration of the company. While the memorandum defines what the company is and, broadly, what it may do, the articles explain how the company is to be run. They regulate the internal relationship between the company and its members, as well as the relationship among the members themselves. The articles usually contain detailed provisions dealing with the appointment, powers, duties, and removal of directors, the rights attached to different classes of shares, procedures for general meetings and board meetings, voting rights and the passing of resolutions, dividend policy and capital maintenance, and the execution of company documents. In many jurisdictions, companies may adopt statutory model articles, adapt them, or draft bespoke articles tailored to their specific needs. From an accounting and audit perspective, the articles are particularly important when determining whether directors have the authority to approve transactions, whether dividends have been lawfully declared, and whether corporate decisions have been taken in accordance with proper procedures. The legal effect of the articles was clarified in Hickman v. Kent, or Romney Marsh Sheep Breeders Association, 1915, 1 ch. 881, where it was held that the articles constitute a binding contract between the company and its members, and among the members themselves. This means that members are entitled to enforce rights conferred on them by the articles, provided those rights are enjoyed in their capacity as members. For CPA candidates, this principle is relevant when considering shareholder rights, governance disputes, and the enforceability of internal rules. The articles may generally be altered by a special resolution of shareholders, but this power is not unlimited. Alterations must be made in good faith and for the benefit of the company as a whole. In Allen v. Gold Reefs of West Africa Limited, 1901 ch. 656, the court held that alterations should not unfairly prejudice minority shareholders. This principle is particularly important in situations involving changes to shareholder rights, restructuring, or shifts in control, and it is frequently tested in examinations through problem questions. Taken together, the memorandum and articles form the company's constitution. Traditionally, where there was any inconsistency between the two documents, the memorandum prevailed. Both documents are public documents and may be inspected by shareholders, creditors, and other stakeholders. This ensures transparency and allows those dealing with the company to understand its legal capacity and internal governance framework. For professional accountants and auditors, these documents provide the legal context within which financial transactions, governance decisions, and compliance obligations must be evaluated. In CPA examinations, candidates are often required to distinguish clearly between the memorandum and the articles, explain their legal effects, and apply their provisions to practical scenarios. In professional practice, accountants and auditors must ensure that the company acts in accordance with its constitution, that directors operate within their authority, and that financial and governance decisions are properly authorized and documented. A clear and confident understanding of the memorandum and articles of association will enable you to integrate legal principles with financial analysis and professional judgment effectively. If you have any questions on how these documents operate in practice, or how they are tested in examinations, please post them in the chat. We now consider the Certificate of Incorporation, which marks the formal completion of the company formation process. This is a crucial concept for CPA candidates, because it determines the precise moment when a company comes into legal existence and acquires rights, obligations, and responsibilities under the law. Questions on this area often test your understanding of legal personality, timing of liability, and the evidential value of statutory documents. So please follow carefully and feel free to use the Chat if anything requires clarification. The certificate of incorporation is issued by the Registrar of Companies once all statutory requirements for incorporation have been satisfied and the prescribed documents have been properly registered. The certificate states the company's name, registration number, date of incorporation, and its legal status. Its importance cannot be overstated, because it is the legal instrument that brings the company into existence as a separate legal person. Before the certificate is issued, the company does not exist in law. After it is issued, the company is fully recognized as a body corporate. The legal effect of the certificate of incorporation is conclusive. Once the certificate has been issued, it is definitive proof that the company has been duly incorporated and that all statutory requirements have been complied with. This principle was firmly established in the case of Jubilee Cotton Mills Limited v. Lewis, 1924, AC 958, where the court held that the certificate of incorporation is conclusive evidence of incorporation and cannot be challenged on the ground that there were procedural defects or irregularities in the incorporation process. For professional practice, this provides certainty and confidence, as third parties dealing with the company are entitled to rely on the certificate without investigating how incorporation was carried out. From the date stated on the certificate of incorporation, the company acquires separate legal personality. This means that the company can own property in its own name, enter into contracts, incur debts and other obligations, and sue or be sued independently of its members. An important point to note is that the company's existence begins at the start of the day shown on the certificate, not at the exact moment when the certificate is issued. This can have practical implications when determining liability or contractual capacity on the day of incorporation, particularly in examination problem questions. The certificate of incorporation also has significant evidential and practical value. In practice, it is commonly required when opening bank accounts, entering into major contracts, securing financing, registering for tax purposes, and complying with regulatory requirements. For accountants and auditors, the certificate provides confirmation of the company's legal status and serves as a reference point for determining the commencement of accounting periods. It also gives assurance that transactions entered into after incorporation are capable of binding the company legally. It is important to understand that the issuance of the certificate of incorporation does not automatically validate pre-incorporation contracts or deeds. Contracts entered into by promoters before incorporation remain unenforceable against the company unless the company enters into a new contract after incorporation, typically through novation. This distinction is critical for CPA candidates when analyzing liabilities arising during the formation stage and deciding whether such liabilities belong to the company or remain the personal responsibility of promoters. In CPA examinations, the certificate of incorporation is often tested through questions requiring candidates to explain its legal effect, apply the principle of conclusiveness to problem scenarios, and distinguish clearly between pre-incorporation and post-incorporation transactions. In professional practice, accountants and auditors must verify the existence and validity of the certificate, ensure that accounting records begin from the correct incorporation date, and assess whether transactions attributed to the company were entered into after it acquired legal personality. A clear understanding of the certificate of incorporation allows you to appreciate the legal transition from a proposed company to a fully recognized corporate person. If you have any questions about the timing or legal consequences of incorporation, please raise them in the chat. We now move to the effects of incorporation, which explain what happens in law once a certificate of incorporation has been issued. This section is extremely important for CPA candidates because it draws together many of the principles we have already discussed and shows how incorporation transforms a proposed business into a fully recognized legal person. These effects have direct consequences for liability, ownership of assets, contractual capacity, financial reporting, auditing, and corporate governance, and they are frequently examined both directly and through problem-based questions. As we go through this discussion, please feel free to use the chat if you would like clarification or practical examples. The most significant effect of incorporation is that the company becomes a separate legal person, distinct from its members and directors. From the moment incorporation takes effect, the company is recognized by law as a person in its own right. This means that the company's rights and obligations are not automatically the rights and obligations of its shareholders. The principle of separate legal personality, firmly established in Salomon v. Salomon and Co. Limited, 1897, AC 22, underpins all other effects of incorporation. For CPA candidates, this explains why company accounts are prepared separately from those of shareholders, and why company liabilities are not treated as personal liabilities of members. A direct consequence of separate legal personality is limited liability of members, where the company is limited by shares or by guarantee. In a company limited by shares, shareholders are liable only up to the amount unpaid on their shares. If the shares are fully paid, no further liability arises, even if the company becomes insolvent. In a company limited by guarantee, members are liable only to the extent of the amount they have agreed to contribute upon winding up. This effect of incorporation encourages investment by reducing personal financial risk and shifts creditor risk to the company's asset base. From an accounting and audit perspective, limited liability affects insolvency analysis, the disclosure of contingent liabilities, and the evaluation of guarantees or securities provided by members or directors. Incorporation also gives the company the capacity to own property in its own name. Once incorporated, any property acquired by the company belongs to the company itself and not to its members, regardless of how many shares a member holds. This principle was clearly illustrated in Macora v. Northern Assurance Co. Limited, 1925, AC 619, where a shareholder could not insure company property in his own name because the property belonged to the company. In practice, this effect requires a strict separation between company assets and personal assets and demands careful scrutiny of transactions between the company and its members, particularly in owner-managed companies. Another important effect of incorporation is contractual capacity. A company, once incorporated, may enter into contracts, assume obligations, and enforce rights in its own name. Directors and other officers act as agents of the company when they enter into contracts within their authority. Provided they act properly, liability under such contracts attaches to the company and not to the individuals involved. For CPA candidates, this explains why company liabilities arise from contracts signed by authorized officers, and why directors are not personally liable unless they exceed their authority or provide personal guarantees. Incorporation also results in perpetual succession. A company's existence is not affected by changes in its membership or management. Death, resignation, insolvency, or transfer of shares does not bring the company to an end. This continuity supports long-term planning, stability of contractual relationships, and confidence among investors and creditors. From an accounting perspective, perpetual succession underpins the going concern assumption, which is fundamental to the preparation of financial statements and to audit assessments. Once incorporated, the company also acquires the capacity to sue and be sued in its own name. This means that the company may enforce its rights through legal proceedings and may be held accountable for wrongs committed in the course of its business. The rule in Foss v. Harbital, 1843, 2 Hair 461 confirms that where a wrong is done to the company itself is the proper claimant. For accountants and auditors, this effect is relevant when assessing litigation risk, recognizing provisions and contingent liabilities, and evaluating disclosures relating to legal disputes. In companies with share capital, incorporation enables ownership interests to be represented by shares, which are generally transferable subject to statutory and constitutional restrictions. This transferability allows members to exit the company without disrupting its existence and facilitates capital mobility and investment. Professionally, share transfers affect equity accounting, disclosure requirements, and audit verification of ownership records. Incorporation also brings with it statutory compliance obligations. Once a company is incorporated, it must comply with various legal requirements, including maintaining proper accounting records, preparing and filing financial statements, submitting annual returns, complying with tax laws, and observing corporate governance standards. Failure to comply may result in penalties, regulatory sanctions, or in certain circumstances, personal liability for directors. For CPA candidates, this highlights that incorporation not only confers benefits, but also imposes ongoing legal responsibilities. In CPA examinations, the effects of incorporation are commonly tested through scenario-based questions on liability, ownership of assets, and contractual responsibility, as well as analytical questions linking legal personality to accounting consequences. In professional practice, accountants and auditors must recognize the legal separation between the company and its members, ensure accurate classification of assets and liabilities, and evaluate compliance with post-incorporation obligations. A clear understanding of the effects of incorporation will enable you to integrate company law principles with financial analysis and professional judgment effectively. If you have any questions about how these effects apply in practice, or how they may be tested in examinations, please post them in the chat. We now turn to the execution of a company's documents, which is a vital aspect of corporate capacity, authority, and governance. Although incorporation gives a company legal personality, the company can only act through human agents, and the law therefore lays down clear rules on how a company validly executes documents. This topic is particularly important for CPA candidates, because improper execution can render contracts unenforceable and may expose directors or officers to personal liability. It is also highly relevant in audit and professional practice when verifying the validity of major transactions. Please feel free to use the chat if you would like clarification at any stage. Execution refers to the formal signing and authentication of documents on behalf of a company in a manner recognized by law. Proper execution is essential because it confirms that the document represents the will of the company itself and not merely the actions of individuals acting without authority. In professional practice, rules on execution are central to determining whether contracts and deeds are valid, whether liabilities properly attach to the company, and whether third parties can safely rely on documents presented to them. A company acts through its organs, primarily the board of directors. Authority to execute company documents arises from several sources, including the Companies Act, the company's articles of association, and resolutions passed by the board of directors, or, in some cases, by shareholders in general meeting. Directors act as agents of the company and may bind it when acting within their actual or apparent authority. If a document is executed without proper authority, the company may not be bound by it, and the individuals involved may incur personal liability. For CPA candidates, this reinforces the importance of distinguishing between acts of the company and unauthorized acts of individuals. Traditionally, companies executed formal documents by affixing a common seal. The common seal symbolized the company's assent in much the same way as a signature does for an individual. Where a common seal was used, it had to be applied strictly in accordance with the company's articles of association, usually in the presence of authorized officers, such as directors, or a director, and the company secretary. Although modern company law no longer requires companies to have or use a common seal, where a seal is retained and used, compliance with the articles remains essential. From an audit and compliance perspective, The use of the seal must be properly authorized and supported by appropriate records, as defects may affect the validity of the transaction. Modern company law generally allows companies to execute documents without using a common seal. In such cases, execution is effected through the signatures of authorized officers. Typically, this involves the signatures of 2 directors, or 1 director, and the company secretary, or, in some jurisdictions, a single director where this is permitted by statute, or the articles. This modern approach reflects the need for commercial efficiency, while still providing safeguards against unauthorized action. For CPA candidates, this is particularly relevant when assessing whether contracts have been validly executed and whether obligations shown in the financial statements properly belong to the company. Special attention must be given to the execution of deeds. Deeds require a higher level of formality than ordinary contracts. For a company, a document must be clearly expressed to be executed as a deed and must comply with statutory execution requirements. Failure to observe these requirements may render the deed void or unenforceable. This is especially significant in transactions involving land, long-term leases, or major financial commitments. From a professional standpoint, auditors must exercise increased scrutiny when reviewing deeds to ensure that execution requirements have been fully satisfied. The company secretary plays a key role in the execution of company documents. The secretary is responsible for advising the board on procedural requirements, ensuring that the necessary authority has been obtained, and maintaining statutory records, such as resolutions and registers. Other officers may also execute documents if they are duly authorized, but such authority must be clear and demonstrable, particularly in high-value or long-term transactions. In practice, lack of clear authority is a common source of dispute and professional risk. The consequences of improper execution can be serious. If a document is not executed in accordance with statutory or constitutional requirements, the company may not be bound by it, the transaction may be unenforceable, and directors or officers involved may incur personal liability for breach of duty or misrepresentation. For CPA candidates, this area frequently appears in problem questions involving defective authority, disputed contracts, or attempts to hold directors personally liable. In CPA examinations, execution of company documents is commonly tested through scenarios involving unauthorized contracts, questions on statutory execution requirements, and analysis of directors' authority and liability. In professional practice, accountants and auditors must verify that significant contracts and deeds are properly executed, confirm the existence of supporting resolutions and authority, and assess risks arising from defective execution. A clear understanding of how a company executes its documents enables you to link legal formalities with financial accountability and professional responsibility. If you have any questions about authority, common seals, or execution requirements in practice, please raise them in the chat. We now come to the final section of Chapter 2, which deals with the alteration of the status of companies. This topic is important for CPA candidates because it demonstrates that incorporation is not the end of a company's legal evolution. Company law allows companies to change their legal status, structure, and internal arrangements in order to respond to growth, restructuring, regulatory requirements, or strategic objectives. These changes often have direct implications for capital structure, financial reporting, governance, and compliance, and they are therefore highly relevant both in examinations and in professional practice. As always, please use the chat if you would like clarification on any aspect as we proceed. Alteration of the status of a company refers to any lawful change in the fundamental characteristics of a company after incorporation. This includes conversion between private and public status, change of the company's name, alteration of share capital, and amendment of the Memorandum or Articles of Association. Such alterations are not informal or discretionary, they must be carried out strictly in accordance with statutory procedures. The law insists on this formality in order to protect shareholders, creditors, and the public, and to maintain certainty and transparency in corporate affairs. One important form of alteration is conversion between private and public companies. A private company may convert into a public company by complying with statutory requirements, which typically include passing a special resolution, altering its constitution, and meeting minimum capital and governance thresholds prescribed by law. This conversion allows the company to raise capital from the public and, where applicable, to list its securities on a recognized stock exchange. Conversely, a public company may re-register as a private company, usually with shareholder approval and regulatory clearance. In both cases, it is important to note that the company remains the same legal entity, only its regulatory status and obligations change. For CPA candidates, the key implications of such conversion include changes in disclosure and reporting requirements, governance and audit obligations, and potential effects on share valuation and capital markets compliance. Another common alteration of status is the change of a company's name. A company may change its name by passing a special resolution and registering the change with the Registrar of Companies. Once the change is approved, a new certificate of incorporation is issued reflecting the new name. It is essential to understand that a change of name does not affect the company's legal identity. The company remains the same legal person, and all existing rights, obligations, contracts, and liabilities continue unchanged. From an accounting and audit perspective, name changes require careful handling to ensure continuity of accounting records, consistency of comparative financial information, and clear disclosure, so that users of financial statements are not misled. Alteration of share capital is another significant way in which a company's status may change. Companies with share capital may alter that capital in several ways, subject to statutory control and shareholder approval. Such alterations may include increasing share capital through the issue of new shares, consolidating shares into a smaller number of higher value shares, subdividing shares into a larger number of lower value shares, or reducing share capital. Reduction of share capital is particularly sensitive because it may affect creditor protection, and for this reason it often requires court approval or compliance with special statutory procedures. For CPA candidates, alterations of share capital are especially important because they affect equity classification, measurement, capital maintenance principles, and disclosure in financial statements. A company may also alter its memorandum and articles of association in order to reflect changes in its objectives, governance arrangements, or internal procedures. Such alterations usually require a special resolution of shareholders and registration with the registrar. However, the law imposes important limits on this power. Alterations must be made in good faith and for the benefit of the company as a whole. Courts will intervene where alterations unfairly prejudice minority shareholders or undermine statutory protections. For professional accountants and auditors, any alteration to constitutional documents must be carefully reviewed to ensure compliance with the law and proper reflection in governance structures and reporting frameworks. Alteration of status may also include the termination of a company's existence through winding up. Winding up may be voluntary or compulsory and results in the cessation of business and the distribution of the company's assets in accordance with insolvency law. From a CPA perspective, winding up marks the end of the going concern assumption and triggers the need for final accounts, liquidation reporting, and application of insolvency and liquidation principles. Although winding up brings the company's life to an end, it is still regarded as part of the broader concept of alteration of status because it represents a fundamental legal change. In CPA examinations, Alteration of the status of companies is commonly tested through scenario-based questions involving conversion between private and public companies, changes in share capital, or amendments to constitutional documents. Candidates are also required to analyze the legal and accounting consequences of restructuring and reorganization. In professional practice, accountants and auditors must ensure that statutory procedures for alteration are properly followed, assess the financial and tax implications of changes, and advise clients on compliance and disclosure requirements. A clear and structured understanding of alteration of the status of companies equips you to analyze corporate change with legal accuracy and professional confidence.